morning. My name is Jenny Wilcock, and along with Terry Dewing and our fabulous team, we run Sullivan Dewing, Chartered Accountants and Business Builders based in Caringbah. Today we are hosting for you a share market update with Andrew Tyrrell from Shaw & Partners. So with the continued uncertainty around the share market, as we deal with the ongoing COVID impacts, both on businesses and on business results, we thought it time to bring in an expert and to get some targeted information on where our share market is heading. We need to know where to invest, what stocks will bring us capital growth, and where we can look to for dividend returns. So we're hoping for some insight from Andrew this morning on such matters. Now, before we start, some housekeeping. If you have any questions, there is a chat box at the bottom of your screen, and there is also a Q&A section actually. So please post your questions in either of those areas and we will answer those at the end of the presentation. I'd like to now introduce Andrew Tyrrell. Andrew is hi Andrew.
Hello.
Andrew is a third generation senior investment advisor with 20 plus years experience. Andrew moved into retail stockbroking about 7 years ago to partner with his father, John, who I've known for a long time as well, working with Shaw & Partners, one of Australia's preeminent investment and wealth management firms. Shaws have a national presence with over 10 billion of assets under advice, offering the intimacy of a boutique investment firm with the resources and scale of a major financial group. We're very fortunate to have Andrew with us today. Over to you, Andrew.
All right, perfect. Thank you, Jenny. And as we will go through, and just a little bit of a disclaimer, which is just a little bit of legality we've got to put through on the second page of the slide. Sorry for Jenny's running the slides, or we had a little technical issue over here this morning, so just bear with us as we get through all this. But just the disclaimers here for your reference. It just basically alludes to everything we say today is general advice and not personal. So just for your reference, I think you all have a copy of this as well. But moving on, the next slide is something that we're very happy with here at Shaw & Partners. It's our fifth year, it's our fifth anniversary at Shaw & Partners. It's something where we had a big branding name 5 years ago. We had a couple of new joiners. We've got a new CEO, and we've created a foundation, which is to date over the last 5 years, we've raised about $3 million for different charities. And then this week is our big foundation week. We're aiming to try and raise $500,000 in the next 5 days. So it's something we're very proud of here at Shaw, and we'll hopefully keep up that good work with many years to come. On to the next slide, which is just about our agenda for today. As Jenny alluded to, we're just going to quickly recap the global pandemic as COVID. I'm sure we're all sick of hearing about that word, and we're all happy to see the back of 2020. We'll see the global response, then we'll move on to the effects that had on the Australian stock market, the risks we see moving forward, the Australian market outlook of where we're seeing the share market to go, where we see some value at the moment. And then at the bottom end, we'll talk about our preferred sectors moving forward, and then we'll give you some of our preferred stocks in those sectors as well. And then, as Jenny alluded to, we'll have questions at the end if that works. But on to the next slide. This is something where it's the global pandemic, and it just showed that fear won the day early on in the pandemic start. The chart on the left there, you can see very sharp downturn from, unfortunately, you might not be able to see the dates, but the first downturn started there in 20th of February, and we dropped almost 40% over a month, which is something we've only seen 4 times before in history. At the bottom, you can see that red vertical line. If we move to the chart on the right, at the bottom, you can also see that red vertical line. The chart on the right is from the WHO region, which is all about the number of cases and the death rates. And as you can see, it was very, very early on within the COVID pandemic where the market hit its bottoms. Reasons why is because fear won the day. It was a lot of uncertainty. And if we move to the next slide, we'll give you a brief rundown of these are just the other tips. So the blue line was the US market, the green is the Australian market, and the red is the FTSE or the London market there, just showing the differences in the performance over that cycle. But on the next slide, which is the one where pandemic is won versus the fear in the market. And it all started with in China, as we know, January, first cases came out. It was the large scale shutdowns, the travel restrictions, and then the huge disruption of the supply chains coming out of China that caused the start of the fear. The next stage was when the virus has started being detected around the world. We saw it in South Korea and Italy, and then on the famous cruise liners, one that docked in Sydney Harbour. And that really got the ball rolling. If you include into that the media and their spread of the increasing negative news and the fear mongering of the media as well, that created this massive spike in volatility where we saw that the market fall off. But that's something we will get through it, and we are through it. But it's just, again, we've just got to realise that the sun will always come up tomorrow, and we've just got to move through. But that's just a quick recap of the pandemic. The next slide you can see has the timeline, which again, it's all that which we just discussed, but this is just for your reference, where you can see late January, the outbreak in China, 21st of February, the Aussie market was at all-time highs. Then we saw the outbreak in South Korea, Italy, the cruise ships, and then we moved through the lockdowns in through March. Then we saw the global response through May and June, and then the lockdowns easing. At the moment, we're right down the bottom, and this is where the two question marks are. Vaccine breakthrough or a third wave, second wave in other countries, bankruptcies, etc. We're hopefully pushing towards the left, where we'll see a vaccine come out of that in the not too distant future. But through all this, it was something from that start back in February. We saw the huge sell-off. It was the best thing that we've seen in a long, long time was the global response. It was something where the whole world started working together on this side of things, and it was around their decisive action to protect the businesses and the people from the economic disruptions being caused, and then also to work together on a vaccine, which is something we haven't seen before, is the sharing of all the information. It didn't matter which countries were sharing the information, everyone was working together, and they still are, which is a fantastic thing to see. The central banks around the world all cut their interest rates where they could. We saw the US cut their rates basically to zero. We've seen that here locally in Australia, where interest rates are at 0.25. Yes, if you're sitting on large cash balances, that does not help because you're not getting any information, any return for that. But it's something where the monetary stimulus coming from those low interest rates is helping the economy. And then something we've never seen before in the sheer scale is the fiscal stimulus being deployed by the big governments. In America, approximately 11% of GDP to date has been spent, which is just over $2 trillion. That's all on, very similar to Australia, on the unemployment benefits, the tax rebates, the corporate bankruptcies to stop small businesses going out the back door. And then similar to Australia, you've got the ones that are helping the renters and the homeowners to avoid their evictions. On the next slide, you can see with Australia's numbers, 10% of GDP, $180 billion the government here spent. To put that in perspective, during the GFC, which was the last big hit to the Australian stock market and the global markets, the Australian government spent just under 2% of the GDP. So you can see this number is 5 times greater than that. The big one here is the JobKeeper, Job Seeker payments, the infrastructure projects, the home builder program, and then the childcare, again, the homeowners and the renters, which is very important here. And moving through to China as well, that's the trillions of dollars have been spent there. I don't have an exact figure of how much they spent to date, but it is unprecedented. And again, it's all spending around epidemic prevention control, medical equipment for the Chinese and for the rest of the world, since they are such a large manufacturer, the tax relief, public investments, etc. So the big global response was very positive for the markets here in Australia and the world. And on the next slide, we can see that the reaction, as you remember on the first slide of the day, where we saw that big sell-off from the lows, and then we saw that rally. The US market has rallied a lot faster than the Australian market and the European markets, and we often get asked the question is, why is America back to all-time highs, where Australia and the UK stock exchange is still 20% off their highs? And the big reason for that is the famous name FANG, which takes up Facebook, Apple, Amazon, Netflix, and Google. So those 5 stocks make up such a large weighting now on the S&P, which is a US stock exchange. They've rallied to unprecedented levels, and that's something which has driven that market so far in the US. And if we look at that little chart down on the bottom left, the blue line is the FANG, and then we included Microsoft and Tesla with that. This is just we won't go into the full details of how call options work, but this is the single stock call option volumes in those stocks. The blue line notional value is about $200 billion for any 1 month of call options. And then the yellow line is the rest of the US market on their call option volumes. And it just shows you the scale of the investment and how narrow the investment in America is at the moment. And that's something which we'll allude to a bit later in the presentation. A bit of a concern that 6 stocks are pretty much controlling the direction of the US market. And that's why they're at their all-time highs. Because again, Australia and Europe and the UK markets are more banks and materials, and we don't have many in that tech space. And then on the next slide, we can just look at the interest rates there, where the US Fed Reserve, that's their interest rate forecast for the next 3 years. As you can see, pretty much flat bottom there, not going anywhere. If anything, they may go a little bit lower, sitting on 0% for the next 3 years. And then the Australian cash rate, the slide next door, our official cash rate is 0.25. The forecast is it's going to stay below that for the foreseeable future as well. So no interest rate hikes anytime soon, which, yes, tough if you're sitting on cash, but that bodes well for the stock market and the gold sector in particular, which we'll talk about a little bit later. The next slide just shows you, again, the movements. This is the 5-year chart in the Australian stock market. We hit our all-time high there, 20th of Feb. 1 month later, we hit our 5-year low, which was down 38.8%, or just under 2,800 points. You've only seen this 4 times before. Once the Great Depression, where the market dropped 60%. The 1970 crash, which my father worked through, where it dropped about 40. The 87 crash, where he worked through that as well, and he said that was one of the worst days ever. I think it was down 25% in 1 day. The GFC, which we all remember, felt like it was just around the corner, but that was a fair while ago now, which was down 50%. So to put it in perspective, this year will be remembered in history for not a year that we've enjoyed, but it's something that the volume and the movements. And if you look back at those 4 previous movements, yes, they happen at the point in time you think the world's over, but we always come back, which is a good thing. And then the rally off the low, which we see there, is all back on that government stimulus measure, the JobKeeper, the JobSeeker, etc. So the next slide we can see are the risks moving forward. And this is something, sorry, I've missed the slide there. That's all right. This one here is the sector that have performed in the Australian market year to date. So as we were alluding to earlier about the FANG stocks in America and the big information technology sector, in Australia, that space has also been very, very strong. That sector to date is up 19%. The big reasons behind that is one name, Afterpay, which is one of these buy now, pay later companies. It's up a staggering, I think from the low, it got down to $9. And I think the last time, about a week ago, it was around that $90 price. So it was an unbelievable move. It's up tenfold from its lows. Again, it is all about that tech space, and there's huge momentum in that space. A lot of money being pumped into there from all different walks of life, but it's something which we need to be very, very careful of. And then you've also got all that cloud computing space. So that information tech, like America, very, very strong. Healthcare up 3%. There's no surprises there because COVID is a health pandemic, really. So that's going to hold that sector pretty strongly. The material space we'll talk about shortly, but that was all driven by Fortescue, which was up 50% on strong earnings, and China and the iron ore demand coming from China. And then the worst sectors year to date, and these are the ones where we're seeing some value, is the energy space. That's down 42%. Energy and oil is a barometer for global growth. At the moment, during the pandemic, global growth is anemic, if anything at all. Hence, the oil price has fallen down a long way. Financials, we'll talk about shortly as well. The big major banks, they've unfortunately been on a hiding to nothing since the GFC. We've had the Royal Commission hangover still over the top of the banks. We've then had further regulatory action on the banks around dividends and what they can pay. And then we've also we're in a recession. So everyone's just using history as recessions of how bad they are for financials, and hence they're off a bit as well. And then the third worst sector was the Aussie Reits, which is the real estate investment trusts. This is a space that, yes, it's down, but I think we don't need to invest there at the moment. The big reason behind that is in the city where I'm working at the moment, the office space, what's going to happen to all these big office tenants where our building here at Chifley is probably at 35% capacity. If you walk down to Barangaroo, they were sub 10% capacity about a month ago. They're probably about 15 to 20% capacity. So there's huge office areas of the city that are still vacant, and people are working from home. And people now realise that you can work from home. So it's something where the city landscape is going to take a long time to recover. So don't need to be in the big office providers. And then the big retailers, online versus bricks and mortar. Well, if you didn't have an online presence during this lockdown period, you probably wouldn't have survived. So that's something you don't need to play in that game yet for the retailers. But moving on, this is the one where the risk's moving forward. This is the part of the market where we're looking, okay, we've seen what's happened, where to now? The VIX, which is the big volatility indicator. So volatility, as the top line ascertains to, equals uncertainty, and markets really don't like uncertainty. And this is something which is quite surprising. Typically when markets go up, volatility drops because earnings momentum, everything is moving in the right direction. The human psyche, the consumer confidence is all quite positive. Therefore, the volatility has dropped. Unfortunately, at the moment, the volatility is rising with the US market rally. What that's telling us is they're not, they're concerned about the strength of the US market. They're not 100% satisfied with where the earnings are. However, it's just a momentum trade. So that's something which can change very, very quickly, and we need to keep that in mind. Vaccine, that's something which will drive our markets and the global markets higher once it is found or discovered. Unfortunately, at the moment, it is continued to being delayed, but I think it's, if you go back very early in the COVID cases, they're saying it's going to take 18 months to find a vaccine. We're only 9 months into it. It could take a little bit longer, but from what we're hearing globally, and we had one of our big global partners in recently, and they're saying there's a number of big vaccines in phase 3 of the trials, which are seeing some pretty good results. So fingers crossed we can hopefully find one of them this year. If we can, it will be very, very positive for the markets. The second, third wave, we don't really need to talk about this too much. We've seen that in Melbourne. Europe has been a bit of a concern of late. We're seeing a big spike there, but hopefully if people are sensible and we can move through them and move on. But yeah, that's the worst side of things if we do get further lockdowns. The geopolitical risks and the trade wars, this is something which the trade wars obviously happened between the US and China last year, but the big thing on this COVID has discovered is the manufacturing globally. And this is something where what is going to happen, again, we don't know the answers to this, but there's a lot of countries already moving manufacturing out of China because of the risks with China. And it's something, what is going to happen in that geopolitical landscape and the tensions between the West and China. And then for free trade, like if you're moving manufacturing home in Australia, we've lost a lot of our manufacturing because of free trade, because we can't compete with the wages, cost of energy, cost of living in Australia versus other countries. So that's something, is a space to watch moving forward. The big concern we have, or the big outlier and event that is going to come up, is the fiscal cliff, as people talk about, or the reality that we are actually in a recession. At the moment, it doesn't feel like a recession. It feels basically like this big COVID crisis. The main reason behind that is the government stimulus. We saw the government stimulus of the JobKeeper and the JobKeeper payments. That was supposed to roll off in September. It's been pushed out to March next year. The big thing is what will happen when that stops. And this is something which the Australian government is looking at very, very carefully, of how to ration those payments out of the market. And that's something where hopefully by that time we've found a vaccine and the Australian underlying economy will be able to continue, and we may hopefully bypass that fiscal cliff scenario, which will be a great outcome. The last one on there, which again, we don't need to go into too many political sides, but it's the US election. It's Biden versus Trump. Trump, we know what we're going to get, so it won't be a lot of change. With Biden, there'll be a big change in the market, a bit of uncertainty, which the markets won't like. But historically, the Democrats haven't been the best outcome for stock markets initially, just because of the taxes and the concern on the tax. But I think time will tell on that. We've got another month and a half to the US election, so you'll hear a lot of things and you'll read a lot of things in the press. But I think that's pretty much the least of our concern moving forward. So moving on to the outlook of what we're liking and where we're seeing the market. Last night, the US market took a bit of beating. It was down about 2%. A lot of that was around two things. One, you were seeing a bit of an increase in cases or COVID cases in America, which is a bit of concern. They've always had very high cases and the numbers seem to be rolling higher again. And then we're also seeing a few, they're trying to get some more stimulus packages through in the US market at the moment to help their economy. That's getting held up in the Senate at the moment. So that's putting the US market and the US people on a bit of a back footing. So we saw a bit of a correction last night in the US market. But here locally, a little bit further pullback will be quite positive. As you can see from this chart, the red line is there is the ASX 200 index. The black line is what we call fair value. And then the grayer line is 15% TSR. So what we're saying on TSR is total shareholder return. Right now, as of yesterday, we're about 13.6 or 13.7% total shareholder return. Of that, that's comprised of a yield, which is income or dividend, of 3.4%, and then a capital gain there of about 10% or just over 10%. So we're getting to the stage to buy. It is very tempting at the moment to buy into the market, which we have been doing a little bit of late, just buying into certain sectors, which we'll get to in a minute. But that just puts it in perspective of where we're at and how we see buy signals. So whenever the TSR gets 15% or above, we think it's worth investing in the market. On to the next slide. We can move into the major banks, which I'm sure a lot of you have got interest in. Most shareholders have pretty big holdings in major banks because historically they've paid very, very good dividends. The chart on the right we'll move on to first. You can see that the purple line there is the ASX 200. The red line is the ASX financials, which is predominantly the banks. And you can see it's underperformed in a very, very large way. There's a number of reasons to that, which are on the left-hand side there, which we'll quickly just skim through because you can read this at a later time. But basically, it's the fears and the effects of contractions. It's the less investment activity and borrowing due to the uncertainty, which we've discussed. The interest rates being so low, less people are putting money in the banks because they're not getting much return for it. And then you've also got the lower income and concerns for employment going forward. The Royal Commission hangover is another handbrake for the banks, which we've discussed. But my view and the view of our analysts here is a lot of this bad news is already priced into the banks. The banks, where they're trading at the moment on their PE levels, which is a price earnings indicator level, they've priced this bad news in for perpetuity. So a lot of the analysts are saying, well, the banks are going to pay about $2 billion a year in bad debts. And they're pricing that in for perpetuity, which is not going to happen. Yes, it will happen for a couple of years. And then as the economy recovers, we can move through that. So I think all the bad news in our view is priced into the banks. They will move around a bit, but we think they're certainly showing some value down here. The positives, the reasons to be positives for the banks are one, the global stimulus, which we discussed right now, and then for the future, which is going to continue to support the economy. And the pent-up demand due to these lockdowns. As we saw the first time we got our lockdowns here in New South Wales, huge increase in spending across the economy. So that's something which is going to continue to drive these banks. They've also moved out of a lot of their wealth management businesses, which was a big thorn in their side during the Royal Commission. They've passed a lot of that. A lot of the remediation charges the banks have been pushed through as well. So at the moment, our top picks in the banks, this is order of preference. So we like all four major banks on valuation grounds, but our top pick is NAB, then it'll be followed by CBA, then Westpac and ANZ, but I'm sure we'll get some questions on this towards the end. The next slide this one is just a valuation ground, but the most important one here, which I wanted to highlight, is the DPS estimate. So that's the dividends per share estimate. So as at 20th March, which is basically the bottom of the market, our estimates on the ANZ was $1.09, CBA was $3.42, NAB $1, and Westpac $1. By the 28th of August, you can see that they've all been cut quite significantly in those dividend estimates. And that was something where, when I talked about the regulation coming in and hurting the banks, that's where APRA's come through and said to the banks they can't pay out any more than 50% of earnings, which it's an interesting thing because APRA's put a lot of handbrakes on the banks around capital ratios they've got to hold, and then the bank earnings are still very, very strong. But then to come out again during this crisis and tell the banks that they can't foreclose loans, they've got to give everyone time to pay, But on the same breath, they don't sit there and say, well, you actually can't pay out your earnings either, which is something which will be discussed for many, many years to come. But it's the dividend impact on the banks has dropped their yields considerably. They've normally been paying north of 5%. Recently, they're close to 6% yield. Our view is those dividends will return. Yes, right now, it's looking pretty bleak on the banks. Yeah, Westpac didn't pay any dividend for their first half. The divs will come in the second half, but our view again for the banks is the div by 2021 into 22, the bank dividends will be back to normal. So that's a positive, and that's why we're also seeing pretty good value in those banks. On to the next slide. This is one, if you remember back earlier on, I said the energy sector was one of the worst. It was the worst sector of the stock market for the year to date. There's a few reasons behind that. As I alluded to, that energy is a barometer for global growth. You pull growth out where energy is going to fall. At the same time, we also had the big OPEC breakdown where you had the OPEC cartel, which is all the oil petroleum companies around Saudi Arabia, and the Russians having a little bit of a tit-to-tat, let's say, where the Russians were trying to not increase or not cut supply. They were trying to increase prices so they could get a better outcome for themselves. Saudi Arabia, in short, retaliated and then dumped a lot of cheap oil on the stock market, also on the commodity market, which we saw the oil price fall over. At the same time, the world was going through the first stage of COVID lockdown, which doesn't help either. In the chart on the top right, you can see the oil price moved from about $65 a barrel, got to a low almost at $20 a barrel. At $20 a barrel, there is no oil producer who can make money. And that's the big thing where, yes, our view it is short-term pain down there, because if no one can produce oil, if no one can make money producing oil, where a lot of the corporations around the world will stop producing oil. And a lot of the countries where in Russia, in Saudi Arabia, Iran, they live off the profitability of oil. So we knew it was going to be a short-term thing. We saw a pretty big quick rally back on the oil price. It's now sitting around $40 a barrel. We still see this as a very, very cheap price for oil. Our big oil names, which we like, are being Santos, Beach Petroleum, and Woodside Petroleum. They're very good producers of oil, very low-cost producers of oil. For example, Santos and Woodside, they're about $25 a barrel is their all-in costs. So at $40 a barrel, they're making about $50 a barrel profit. So the balance sheets are in strong working order, and we see that oil price as we get through COVID and the global economy expands, the oil price is going to rally with that, and that was going to be a huge positive. And onto the iron ore sector here. This is one we certainly like. We spoke about this a couple of years ago with a few of you in that presentation then as well. And this is a sector we continue to like. You can see from the chart, that's the iron ore chart on the right-hand side. It's had some very, very big moves, but the general trend is positive. We saw there through 19, it hit about $120 a tonne. Right now, the iron ore price is circa $125 a tonne, which is a very, very profitable price for all our big miners here. The reasons behind this is, one, the Chinese demand for iron ore continues. It is very, very robust. And it's something where China is, the way they look at it is, if we can continue to spend money on infrastructure and expansion of the Chinese economy, how they do that is by making steel. The biggest ingredient in steel is iron ore. And that's where we've seen that continue through in our iron ore price here. And we see this demand for China's reurbanization is going to continue through 2020. And the other side of it, which is also a positive, as we move through COVID, the rest of the world demand for iron ore, because infrastructure spend is the easiest thing for governments to spend money on once the economy starts improving, because it's a huge employer of people. And the biggest thing or a very large thing for infrastructure is steel, and that bodes well. That will continue to keep the demand high for the iron ore price. The two picks here are BHP and Rio. They're both very, very large diversified operators, huge global presence. The earning cash flow is very, very strong. So at $125 a barrel, Rio and BHP are making about $125 a tonne. Rio and BHP are making about $110 a tonne profit, cash profit at that price, which is an astronomical number when you're talking about they'll dig up about 300 million tonnes of iron ore per year. We spoke about Fortescue earlier about how they drove the material sector to be positive, and they're up 50% year to date. Fortescue we like as well, as BHP and Rio. However, at the current price level, Fortescue's close to $18. We see there's less value in Fortescue at the moment because it has certainly outplayed BHP and Rio in this recent rally, and we think that's probably their price will stay around the $17, $18. BHP and Rio, we see has got plenty more upside in them, so that's certainly a couple of stocks we like there. This chart's just the iron ore. It gives you a quick understanding, so you can see the different years there and the different colours, and it just shows you the demand for steel and the demand for iron ore coming out of China still. So that's a huge positive for our big miners. And then the final sector that we like, and this is sometimes a point of conjecture with people, is gold. It's something where you can see the chart on the right. Again, very, very strong rally in the gold price, which has normally been trading sideways for the last number of years. The big reason behind this is the expectation of negative real interest rates, which we'll talk to what that means in a second, but it's basically negative real rates underpins the price of gold. The central banks around the world have committed for those near zero interest rates, as we saw on that slide with the US Fed, their interest rates looking to be zero for the next couple of years. And as long as inflation remains above zero, which it is at the moment, the government bond yields will have a negative return. What this means is they'll look for other areas of investment than just putting money in a government bond. So a negative real yield, what I mean by that is if you're sitting money in the bank and inflation's giving you a bigger return than the actual bank return, you're going to go backwards in your real cash. What that means is these government bonds, a lot of the investors, they're saying, well, we don't need to invest there. Let's have a look at something like gold, which is a safe haven asset. And for relative value, a lot of them are moving into that. And we can see that from the demand in the gold price as the big institutional investors who normally buy these government bonds are now buying gold. Going back to history, the GFC showed this as well. When we had negative, it was the last time we had negative real interest rates. The gold price followed an upward trajectory for the next 4 years post the GFC. We see the gold price here probably not continuing an upward trajectory. We're just seeing it probably going sideways between that $1,800 to $2,000 an ounce. And that, again, is going to bode well for the big gold producers in Australia. Our top pick in this space is Newcrest Mining. It's Australia's largest gold producer. It's the lowest cost producer. It's got huge margins. I think they're all in costs off one of their big mines in Australia, which is out Cadia way. They're about $300 an ounce. So around $1,900 an ounce. They're making a large amount of money. They've got a huge pipeline of growth opportunities around them as well, and a very strong balance sheet. So the gold is certainly a space we like as a play in this time. Gold is not something we would hold forever. It's more of a trade. But Newcrest is a very, very large company and it's a safe bet at the moment. The downside is with gold, unfortunately, we don't get a lot of income for that. But I think the capital growth we'll see out of that name will be better than the income for gold. And then just onto the quick last slides here. This is just more for your reference. It's something, the PE, which is a price earnings indicator of the stock. So it's the price of the shares divided by the earnings. This is something, if you look at it just here, it may confuse you. So I won't go through it in a lot of detail, but it's just more on the bank slide. We can see their earnings estimates there on the PE numbers. So for CBA, they're at 16 times. If you can compare that to NAB, Westpac and ANZ, which are in 12 and 11 times earnings, historically, they are very, very cheap. If we look at defensives, which in this space, they're around 25 times. So they're slightly more expensive than where they normally trade. If we go to the next slide, which is the one which you wanted to see, which these are just all the different sectors in the market, you can see the top left corner, the OS growth. So these are the overseas growth numbers, and this is where the Afterpay, the Xero, which is the accounting software firm, WiseTech, Illumina, things like that, realestate.com, they're all trading on very, very high PEs. And that's a sector that's had a huge momentum behind them and a big growth swing. They're a space, yes, momentum's there. There's still probably upside in them, but it's something to be very wary of. So once growth does come back, where are investors going to get the money from? And they'll probably be selling that space to invest into the other names. And just to give you an example of price versus earnings and what it can do to your PE number, The top yellow one on the right is Sydney Airport. It's got a PE now of about 73 times. Reason behind that is the share price has dropped. The share price is about half what it was. However, the earnings are about 10% of what they were. So you can see why that number's got so large, is because the E part of the earnings is just completely disintegrated on Sydney Airport. So now if you look at it, you go, oh man, it's 73 times. That means I've got to hold the shares for 73 years before I make my money back on Sydney Airport. You're probably going to go, I don't want to be there. So, however, looking at Sydney Airport, it is a monopoly of New South Wales or the Sydney and the airport. It's the third busiest route in the world is between Sydney and Melbourne. Yes, right now it probably can't get worse for Sydney Airport because no planes are flying. However, if you're looking forward, we get past COVID, we get past all that first fear of flying on a plane again, and people realise, hey, I didn't get sick. We can do this more often. Sydney Airport is a name that will certainly turn around. So PEs aren't always everything they are cracked up to be. And it just gives you a quick visual snapshot of where we're seeing value and where we're not seeing value. And then the bottom right there, it just gives you the market, which is on 18 times, where the banks are at 13 times. And it just gives you an understanding of where money's been flowing into the market. But that will basically, we can finish the presentation there.
Fabulous, thank you, Andrew. I'll just take our PowerPoint down so that I can access our questions. So that was very informative, very interesting, actually. So I'd like if everybody could get their questions posted, that would be fantastic. So the first question that we have this morning is your thoughts on the share market. So we know that that JobKeeper 1.0 is finishing at the end of September, with 2.0 kicking in up until March. So do you see the share market continuing to recover between September and March? And then what are your thoughts once we hit March?
Yeah, no, it's an interesting question, and it's something with the JobKeeper coming off. It's a very smart move by the government, because they couldn't just stop it. Because I think as the JobKeeper is keeping a lot of people employed. So I think if the companies weren't making that $1,500 a fortnight to keep people employed, they would have just fired the people there and then. So you would have seen a huge spike in the unemployment number. We saw the employment number out this week last week, it came out, and it surprised to the upside. It was very, very strong. So our unemployment went from 7.7 down to I think about 6.8%. We saw 115,000 jobs created for the month. And I think that this JobKeeper seeker is very, very positive for that. Yeah. The fact that continuing it out to March is going to continue to bode well for the stock market here. And I think the big thing is the government stimulus is one side of it. The second side is the vaccine, and then the coronavirus. So if we can find a vaccine, yes, it's still going to take years to come out, but if we can get more positive news on that, that will drive the economy. Then if we can get through, like Melbourne, hopefully we'll get out of this second phase lockdown. New South Wales, Queensland, they've done a fantastic job. And if we can get through all this without getting lockdowns, we can all move into Christmas and enjoy ourselves. I think next year, between now and March, my view is there's going to be a few bumps along the way, without a doubt. But I think the market will be higher from where it is today by March. Yeah,
fantastic. Do you think it will be back to its highs?
By March, I wouldn't think so. I think to get back to those highs, we're going to need the banks to move.
Yes.
And I think the banks, it's going to take time with the banks, because the bad debts, and the biggest concern we have is, and as the government's alluded to, is if people lose jobs, that's when the recession is really going to hit home. And this is something at the moment, we are in a recession. It's the first recession we've had in 28 years or whichever it's about, but it doesn't feel like a recession because people are employed. The tradies are flat stick. They don't have capacity to do more work, and that's something which is hugely beneficial for the economy. And as long as that can continue and we're not seeing a big hit to job numbers, I think the bank rally is going to start sooner than later. And that's something we're just got to be wary of. The job number is very, very important. And that's where if we're seeing a big spike in unemployment, it's probably the all-time highs is going to be further away. But if we can see unemployment continuing to improve, I wouldn't say March, but hopefully sometime in 21.
Yeah, and it's very interesting. So we're seeing across our client base that that there were a lot of clients that got JobKeeper 1.0, and that was purely based on the slight dip between March and April, but and then the businesses really have picked back up, and quite a lot of them have had very profitable few months trading, while continuing to receive the JobKeeper quite legitimately. But with JobKeeper 2.0, there's a lot of people that just won't get that. So it certainly will be interesting to see sort of how that's weathered on the business results, because it's the JobKeeper across our client base certainly has given so many people so much more confidence to keep going and keep pushing and keep their employees on. But also we've seen in so many different sectors in our client base that the businesses that have pivoted, that have reinvented themselves, that have changed the way they've done things, that have actually taken huge advantage of the environment that we have at the minute, and it'll be interesting to see sort of again how much of that continues, but it's certainly the JobKeeper 1.0 is going to have an impact. There's no doubt. Okay, a question from one of our audience members: should I buy Telstra?
Telstra, I know I didn't put that in my presentation because I should have. Everyone asked us about Telstra. It has been a horrible period of time for Telstra. Ever since the NBN got announced, Telstra's pretty much slid. It was at $6, I think, and then the NBN got announced, and it's just been going backwards for the last 3 or 4 years. At the moment, at $2.80, Telstra is certainly showing a bit of value. I think Telstra really gets hard done by. It's a bit like the banks. The press love to beat the banks like they do with Telstra. Everyone you talk to has a bad story dealing with Telstra. There's very rarely do you get a lot of positive stories for customers who've dealt with Telstra. That will hopefully change going forward, and that's certainly something they've got to work on. But in my view, Telstra selling the copper network to the NBN, it's a deal which I've spoken to a few people about, and I think it's probably the deal of the decade, where everyone looks at me as if I'm a bit crazy, but they've sold a copper network which is obsolete in 5 years. And they've sold this copper network for something like $20 billion back to the government. And my view is they've just sold something that is worthless, and they're getting $20 billion for it, which is a great outcome. The downside to this is Telstra's lost that monopoly and that control. And that's the bit where the share price has come back a long way. Looking forward, though, I think 5G is the way. It is the future for Telstra, for Optus and the other telco companies here. It's something where we've just got to move forward and see how that goes. The dividend's been supported by the NBN payment, which we're seeing there. They pay about a 3-cent special div. The normal div's 5. I wouldn't be buying Telstra for a strong dividend yield like it used to be, but I think you'd be buying Telstra for the delivery of 5G and if they can get it right.
We've got one comment from one of our audience. Telstra pays great dividends. No way I would sell my staff issued shares anytime soon. So Telstra supporter there. Okay, very good. What are your thoughts on these deferred dividends? Do you think they're actually going to be caught up, or are the shareholders never going to receive that money that's not been paid?
Yeah, or whether the banks will pay out a special div going forward, they may. They're not going. The banks, in my view, is you saw ANZ and Westpac. They both deferred their divs from their March payments. Yeah. Then ANZ came in and said, okay, well, we're going to pay out 20 cents, I think it was, or 25-cent div on their quarterly result, which we thought they'll do. And we're hoping Westpac was going to do the same. Westpac came in and paid out no div, which, it hurts. I've got a few Westpac shares myself, and I was looking forward to a div, but that hurt. But it's something where, looking forward, I don't think the banks are going to sit there and say, okay, hang on, we didn't pay a div in 20, so let's make 21 a bigger div. I don't see that happening. The banks, in my view, will return to a normal dividend cycle. I think the biggest issue we've got to do first is to make sure everyone's staying employed. They're not getting as bigger hits in the home or the bad debts against home loans. Then we can move forward. 21, I think the dividends will increase of what they paid in 20. We'll see, hopefully, in these November results for the ANZ, NAB and Westpac, we'll get a better understanding of where they're placed with the dividends. And then the big issue at the moment for the banks, like CBA wanted to pay out more. CBA's dividend, they paid out $1. On their results, they could have paid out more than that, but it was APRA that's restricted the bank's payments. So at the moment, APRA is saying the banks can't pay more than 50% of earnings, where typically the bank dividends are anywhere between 65 and 80% of earnings. And that's the bit which will change.
How long's that cap lasting, that APRA imposed cap?
It didn't say. They just came in and forced it just before the quarterlies of ANZ and Westpac. The view is we'll probably find more of an update again on the next dividend cycle of what APRA and their handcuffs are going to be. I don't necessarily agree with it. I can understand why they're saying it because they want the banks to stay very, very capitally strong, or in their view, I can't remember the exact terminology, but they wanted the banks to be in the top 25% of global capitalised banks in the world on a tier 1 ratio. 3 of them are in the top 5, which is CBA, ANZ, and I think NAB are in the top 5 on capitalisation level. So they are ridiculously strong on a balance sheet perspective, and I think the government's just being over-regulating there. Hopefully we can...
Overly cautious.
Yeah, and we can move forward on that.
Yeah, that's it. Okay, so another question from our audience. We've seen some companies have a huge surge in income due to COVID. Companies like JB Hi-Fi. So, what are your predictions on companies like that for the next few months?
Well, yeah, as alluded to earlier on the retail, the bricks and mortar, it's online versus bricks and mortar, and the online sales and this is again, it's if we look at two sides here. Like on one hand, we've got retail online sales at all-time levels. We've got companies that like Shaver Shop that's been doing it tough. All of a sudden is really kicking goals. It's gone from 30 cents to 85 cents on a share price purely on online sales.
I didn't think anyone was shaving anymore. Isn't everyone throwing a beer?
Well, this is the thing. I think everyone's locked down. They're going, well, let's go do something else. But I know, I hear you. But it's one of these things where you look at that, you look at JB Hi-Fi, and a lot of that is two things there. One, it's online. Two, people are working from home, so they need the computers, they need the technology. And then three, it's this government, two others. Three, you've got the government stimulus, the JobKeeper, JobSeeker, where people are getting this money. There's a lot of people, not everyone, but are getting more money than they're getting before. And they're going, well, let's go spend this money. So they're all buying the new TVs, they're buying the new computers, the video games, whatever they're doing. And then the other one is this buy now, pay later space, which in my view is a little bit concerning where, again, who uses buy now, pay later? Typically a lot of people who don't have credit cards or can't get credit cards. They then log on and they just go to the JB Hi-Fi and they go, buy now, pay later, subscribe, done. And then they buy it and they realise later, hey, we've got to pay these guys back. But that at the moment, that space is really, really strong, and there's I have a huge concern in that area is if we do get a recession or reality check, people aren't going to pay back those loans because they're very, very small.
Absolutely.
But JB Hi-Fi, fantastic story. It's a fantastic company. It's evolved over the years from an old CD company and a cassette company to the leading seller of TVs and everything else. It then joined up with Good Guys, which gives it all the fridges and the vacuum cleaners, etc. So very smart business operators, very good company, but at $50 a share, it's probably at the top end of its valuation, I think.
So would you say a company like that has done well out of this pandemic, would you say that they would be increasing their dividends?
Not necessarily. The dividends all comes down to, it's not just a factor of earnings, it comes down to how the company's structured and what the company pays out. But typically, like if you look at Woolworths, where the dividend yield is always quite low, but they're making, again, like JB Hi-Fi, or the supermarkets have done very, very well. The Dan Murphy's has killed it because everyone's drinking a lot more due to this lockdown and having kids around at home. But it's something where exactly, but it's not always a factor because their earnings have been very good, but then they look at what they're going to do with those earnings, and it's a big thing. Like the big miners, like Fortescue paid out 10% this year in income, which is unbelievable when you think the cash rate's at 0.25, but Fortescue, they didn't have anywhere they needed to spend the money. Where companies like JB Hi-Fi, they're probably looking at the other sectors, other things they can do or where they need to move to. So they they retain a lot of their earnings. Where a company like Fortescue, they have next to no debt and they've made an unforeseen amount of money this year, and they go, well, let's just reward the shareholders. So they paid 10%, but I wouldn't buy Fortescue thinking they're going to pay 10% next year because that could change. But yeah, normally as earnings increase, dividends should increase at the same time, but it's not always a perfect math science.
That's it. Another question on the unemployment. So, referring back to the good news on the unemployment that we had last week, but the share market didn't seem to react quite that well to it. Was it already built into the share market, or why didn't the share market react favourably?
Yeah, it's a very interesting question, that, because you would expect those unemployment numbers were a surprise for everyone. Like the economists, so how the share market works, all the economists will put out there and all the analysts will put out their forecasts for the job numbers. I think the job number forecast was supposed to be negative 33,000. The unemployment number was actually supposed to go up. This came out, massive surprise to the upside, 110,000 jobs. The big thing was the quality of the jobs. A lot of it was part-time.
Yeah.
And the other thing was the average hours worked, which was down. So it's showing the production level, the productivity level and everything else, the average hours worked had dropped. So that was the bad news within the good news, if you'd like to put it that way. And I think the unemployment number itself, we don't look at it that closely because it does change a lot from month to month and week to week.
Yeah. Okay. So
I thought I lost you there, but it's something where, moving forward, I think it's just at the moment it felt like good news was bad news on the market. I think the unemployment number, the fact that it's some form of job, is very, very positive. And I think the market reaction was pretty subdued in that. And I think it's something where at the moment the market kind of feels like it wants bad news, so then they get more stimulus, which is going to drive it further. But I wouldn't read too much into it. I think it was 1 month change. It's good news, and if we get some more months like that, it's positive news, and then you'll see the other side of the market moving.
That's what we're looking for, isn't it? Okay, question, another from the audience. What happened to Macquarie share price last week?
Oh, yes, Macquarie. They came out with a downgrade last week. They had a 35% earnings downgrade, which surprised a lot. We'd all had priced in about a 10% drop in the Macquarie share in their earnings, and they came out and said their earnings are going to drop by 35% this year. Not really a big surprise that their earnings are going to be down, but it was a big surprise compared to what the market was expecting, and therefore we saw that $6 fall. I think it's about 5-6% fall in the one day, but a very good result in the end, where normally when a company surprises on an earnings downgrade of that magnitude, you'd expect the company to drop 25%.
Yeah.
Macquarie didn't. The concern I have, Macquarie, fantastic company, fantastic bank, don't get me wrong. The concern I have for Macquarie is a third of their earnings in America, a third of them in Europe. America and Europe, especially America's doing very, very well, but my concern is once everything slows down, people are going to realise, oh, hang on, we've got a huge hole here with unemployment. And Europe, there is upside to come, but I think the market hasn't priced enough a lot of the downside in for Macquarie. My view would be closer to $100, you'd certainly look to pick it up, but I wouldn't be buying a lot up here at 130 at the moment.
Yeah, understand. And so we have a lot of clients with self-managed super funds. Where should those super funds be putting their money? So you've given us some tips today.
Yep.
You've talked about BHP and Rio in the iron ore sector.
Yep.
You've talked about Newcrest in the gold sector.
Mm-hmm.
You've talked about the banks. Good old banks.
Banks, I know.
Yeah, NAB, CBA. So your preferences were NAB, CBA, Westpac, and then ANZ?
Yes. Yep. So the view, depending on the super fund, and if they didn't have money in the market and it was a new super fund and they're sitting on cash, all those names you could buy. Yeah. Without a problem at all. There's other names we could add into it, like the Telstra one we spoke about earlier. You've got Woolworths and Wesfarmers in there, and Coles, which are long-term super fund stocks, because they're, as we saw and as you may have heard from Dad over the years, that people have always got to eat. It doesn't matter how bad times get, you still got to eat. And that's where the supermarkets, it's as simple as that. Like, it's not complicated. Like, they're always going to do well. And as we saw with that toilet paper pandemic at the start, which I still can't get my head around, but their earnings momentum was very strong. The share prices reflected that at the moment, but I think if you can get Coles around $16, $16 to $17, I think they're around mid-17s. Woolworths back in the low 30s. I think you're going to get some pretty good earnings there. And then Wesfarmers, which is slightly different. That's Bunnings, which is probably one of the best businesses in Australia. And then you've got Officeworks, which with this work from home drive, they're going to continue to do well. So there, you could look at certainly all of them.
What price would you buy Wesfarmers at?
Wesfarmers, they're north of 40 at the moment. I don't have right here on top of me, but I think if it does pull back a little bit, because the dividend's pretty good for Wesfarmers, but it's a company where it's not going to fall a lot because their earnings momentum is pretty strong. They'll be similar Woolies and Coles. And then for super funds who have money invested in the market, that's where it gets a little bit trickier where we look to buy it. Like these are companies we're liking. So if you don't have anything, you can buy them all. If you've got money invested in the market already, you just need to really talk to your advisor or talk to myself, and then we can look through where you're weighted and where you're balanced, because you don't want to get into the mistake of having like 80% of your portfolio or even 60% of your portfolio in the big four banks, because at the moment, that portfolio wouldn't be doing as well as it should be. And that's where it is. We just got to make sure the money is diversified and spread around.
Absolutely, because when we talk about interest rates and no movements for potentially 3 years, even though some of the returns on some of these shares and even the bank shares, particularly more around the 4% than the 6%, it's still a lot higher than returns on cash rates, isn't it?
Oh, certainly, and that's where the market. You've also seen one, the government stimulus has driven the market higher, but also two, there's nowhere else. So you were seeing in property prices, everyone's been saying, oh, the prices are going to crash, the houses are going to crash. Well, around us, we had a mate of mine is a realtor, and he sold 9 of the last 10 houses pre-auction.
Yeah.
And they were all sold within the last week. And I'm there going, this is unbelievable. And he said, yeah, it is. They're so busy at the moment. He said, it's unbelievable. He thought they'd be dead quiet. Yeah. They're very, very busy, doing well. So people are buying houses. People are also moving regional. Yeah. Which is normally the first place to get hit hard in these times. But the property places out there, I've been talking to clients, are saying we're having places sell which have been on the market for 5 years. Wow. And they're selling. So that's a big drive, which is good. And then the other thing is, where else do you put the money? Well, it's the stock market, because there's no one sitting in cash. And that's something which is the other side of it. So we'll keep the demand for the market and the property pretty strong.
Yeah, that's it. Okay, I've got 2 more quick questions for you, but we let you go for today.
Yeah, right.
From Scott, what's next for BNPL companies?
What's next for BNPL? Yeah, that's it's a good question, Scott. I missed the whole Afterpay rally. I kick myself every day because I looked at it so much, and I kept saying there's so many things wrong with that company because it's lending money to people who can't afford it. And there's still momentum in that space. There's a number of companies that are still coming onto the market and listing there. Afterpay, the big thing, what they're doing very, very well is they've got the first mover advantage, and they're moving now into America, then they're expanding into Europe. So they're doing well. My big concern, Scott, is on these. It reminds me of the tech wreck. If you go back to that time on companies that had these PEs, which were astronomically high, Afterpay, I think, if you look on a 1 year or 2 year earnings where they may get some earnings, their PE would be the most expensive in the world. So then you look at it and go, well, hang on, how's this thing trading up on these multiples? And what will happen if we do get that unemployment spike, if we do get a reality check? That's one side. You've got to look at it, and because the debt collectors won't buy that debt, because the average debt is only about $100 to $150. Then the other side of the equation is competition. We saw 2 weeks ago, I think it was PayPal in America have come out and said, well, we're going to do a similar thing. And they have 300 million clients in America. And that's where it's going to start hurting, or even you'll see Visa or MasterCard or something like that potentially come in and then go, oh, fine, we're just going to do 1% credit cards or something just to try and, or 0%. I think America has 0% credit cards. So still momentum there, still a good thing. The stimulus is certainly helping it, but I think, I'll be wary. And if you're making good money, just make sure you always take a little bit off the table.
I think that's good advice. All right, well, we might leave it there. That's some really good questions answered this morning, and some really very good information for us on the state of the share market and what we've come through and what we can certainly look forward to. So for our audience, we will send out a copy of this webinar that you can share around, go back to if you choose to, of course, and the slides will come out to you as well. Any further questions, you can shoot them through to Sullivan Dewing, and we thank Andrew very much for his time this morning. And his contribution for our clients. Thank you, Andrew.
Yep. No, thanks, Jenny. Cheers. All right.